Welcome, everybody. I'm so glad you could join us today. We are presenting our second in a series of the New Market Tax Credit virtual series. Our second session is on compliance, reporting, and applications for new market tax credit. So we're really happy to have you here today. Lauren and I were joking that you can tell we're application writers by our title because we've omitted the Oxford comma. We write for character count. And so we can't afford our Oxford commas. So thank you for joining us. A few housekeeping items to start with before we get started on the presentation. In order for you all to receive CPE credit, for those of you who want that, you have to stay on for at least 3 polling questions and attend for 50 minutes. There will be 4 polling questions, so don't worry if you happen to miss one, you should be still fine, but you do have to answer 3. You do not have to get the right answer, although in a lot of our questions, there is no right or wrong answer. So just go ahead and answer something and you'll get that credit. CPE certificates will be issued via email within about 10 days. Don't freak out. If it's not there within 10, give us another day or 2, but it should be in your inbox soon. Anybody who wants to go back, or if you found this interesting and want to share it with others, there will be a recorded version available after this broadcast, so you will be able to share this with others. Don't forget that you can interact with us, so you can put questions in the Q&A box, and you can also do reactions, so you can clap if somebody does something well, or you can heart something, celebrate. So don't forget to just interact and stay awake with us and let us know how we're doing for you. And then there will be a short survey posted at the conclusion of the webinar. If you wouldn't mind giving us your feedback, we would love that. Now that I've covered the do's and don'ts and all of the to-dos, I'd love to introduce you to our 2 speakers today. Lisa Gibson is the director of our strategic financing services management side. So she does our compliance, asset management. She basically holds the hands of a lot of CDEs and offers them whatever advice and guidance they need to assist them with their program. The wonderful part of Lisa is that she knows so much, but that she's also very collaborative. So whatever you're great at, she lets you shine. And then what you don't really love doing or you're not great at, she can help you with that and also wrap around that with other services on our team. So Lisa will share some of her expertise with you today, but if you have questions, you can always feel free to reach out to Lisa and she'd be happy to chat with you after our session. Lauren Kilburn is going to start us off today after I get done speaking, and she is going to share with you some application do's and don'ts and some tips that we've learned in our work with our various clients. And so, Lauren, I'm going to turn it over to you and you can get started letting people know the rules of the road. And I guess we'd start with the agenda. Thanks, ladies.
Thanks, Laurel, for the introduction. And thank you, everyone, so much for joining us today. We're excited to condense all of the new markets application and compliance matters into 1-hour course for you. And so we tried to, really hone in and focus on the elements that are most important. So we're going to kick things off in talking about the new markets tax credit allocation application with the idea that it's really the guiding document that's going to allow a CDE to receive allocation and how important it is to adhere to that document to ensure that you are remaining compliant with the CDFI fund as well as the IRS. And then we'll bump things over to Lisa, who's going to discuss all matters of compliance, all of the reporting that would go along with your allocation, and then trying to develop a better understanding of all the parameters around the deployment of your allocation. So things that you need to keep in mind as you're starting to invest in these projects. And then we'll close with a sort of overview of managing your investment over that 7-year compliance period. So we'll go ahead and get things started here and kicked off with our very first poll of the course. So we would love to know what brought you here today to listen to our webinar. So perhaps you're interested in learning more about new markets tax credit applications. Maybe you're here because you want to learn more about compliance and all of the elements that you need to keep in mind once you have allocation. Perhaps you're just here because you just need 1 more hour of CPE credit to hit your professional development goals this year. But if there's another answer that we have not addressed, we'd love for you to share that in the chat with us today. Okay, I see all of you CPE credit people. But we really hope that, whether you're here, just to get 1 credit hour professional development, that you learn something that you can take it back to your organization. Perhaps your organization has been thinking about entering the world of new markets tax credits. And so this is a great sort of introduction of all the things that you should keep in mind as you're starting to explore that pathway. Great, so we can go ahead and jump from here into just a general overview of the New Markets Tax Credit Program. So the New Markets Tax Credit Program was enacted by Congress as part of the Community Renewal Tax Relief Act of the year 2000 and is incorporated as Section 45D of the Internal Revenue Code. And the program permits both individual and corporate taxpayers to receive credit against their federal income tax liability in exchange for making what's known as a qualified equity investment, or a QEI, into a qualified community development entity, or a CDE. And we'll dive more into some of these acronyms later as well. So this tax credit ends up being equal to 39% of that QEI, which is then taken over a 7-year period. And so that works out to be 5% in years 1 through 3 and 6% in years 4 through 7. So essentially, this equates to 39 cents in tax credit for each dollar invested by that investor. So since inception in the year 2000, the program has been really, really successful. The CDFI fund has awarded $71 billion of allocation since the program's inception, which has led to the creation and retention of nearly 1 million jobs across the country, over 270 million square feet of new and rehabbed real estate across the country. It's funded a really wide range of project types. I think that's the really fun part about New Markets, is that you can do so much with it. You can fund, equipment purchases for a manufacturing plant, or build a new childcare center in your community, establish a new health clinic, build a grocery store in a food desert. So all the things that, are really needed in your community, most likely. And at the same time, they're creating these wonderful projects. They're also providing substantial financial benefits to borrowers that they would otherwise have a really difficult time finding in the conventional financing market. So for example, some of the flexible features of a New Markets tax credit loan would be a below market interest rate, often up to 50% below market, if not more, 7-year interest only periods during that time, lower but often no origination fees, higher loan to values. So these are a lot of things that, many borrowers would see as a barrier to accessing conventional financing, which makes a New Markets loan quite enticing. And just again, to illustrate the success of the program, for every dollar of New Markets tax credit that's invested, that leverages an additional $8 in private investment. So that really illustrates the program's success in being able to stretch federal dollars and leverage public and private sources together. Okay, so we're going to go into a very high level structure of the New Markets tax credit program. So this would be a very simple structure. So the New Markets tax credit program is administered by the CDFI fund, or the Community Development Financial Institutions Fund, which is a department of the U.S. Treasury. And the CDFI fund works with entities called community development entities who submit applications to the CDFI fund requesting an allocation of tax credits. It's a very competitive application process. The most recent round of awards were announced just this past October. Those awards range from $20 million to $60 million of allocation. So it's worth noting, though, that does not mean that a CDE is receiving $60 million. Instead, that means that they are receiving the authority to allocate $60 million worth of tax credits to an investor. So then once if the CD is successful in receiving allocation, they are then eligible to sell those tax credits to investors. So this is the next leg. Typically, these investors are large commercial banks that have a substantial tax liability. So they want to purchase those credits because they received that 39% reduction based on the size of the QEI against their federal income tax liability. And then also for a lot of large banks, they are interested in obtaining that CRA credit for their investment. So there's kind of like two sides to their interest in participating in the New Markets program. So the investor pays a market rate for those tax credits. Today it's floating roughly around 80 cents per dollar. And the sale of that tax credit or purchase of the tax credit by the investor would generate an equity investment. We can go ahead. There we go, Lisa. Awesome. And so a key part of the New Markets program, though, is that it's a gap financing source. So the investor equity is only going to cover sort of like the last gap in your financing stack. Typically, we say maybe 20 to 30% of the total project costs, which are fulfilled by the tax credit equity. But that means that the project is then responsible for sourcing the remaining 70 to 80% of the total project cost from another source. And that can be, truly anything. It can be your traditional bank debt, sponsor equity, grant proceeds, perhaps your nonprofit has gone through a capital campaign, and all of that is brought together and now is known as the leverage. So these leverage funds are then married up with the equity contributed by the investor. And those two together are fulfilling the QEI to help you close your full project financing gap. And we can go ahead and click through there, Lisa. Great. Awesome. So the CDE sells the tax credits to the investor, and then that generates a qualified equity investment, which is then paired with your leverage fund. So we can click again. Wonderful. Awesome. And then very high level. So we have that qualified equity investment, which then moves through an investment fund down to the community development entity, or the CDE, in the form of a qualified low-income community investment, or QLICI, which is then received by the project, which in New Markets speak, we call it a qualified active low-income community business, or a QALIC-B. So like I said, a mouthful of acronyms. Right. So as I mentioned in the previous slide, there's a lot of competition for a very limited amount of allocation. In the very first round, which occurred in 2001, 2002, there were 347 applicants and only 66 CDEs were actually successful in obtaining that allocation. So that's less than 20% of applicants. In the round that was announced in October of this past year, 199 applicants competed for $5 billion worth of allocation. And just 107 of those CDEs were actually successful in getting allocation. So as you can see here, the gap between the number of applicants and awardees has been trending smaller over time, but the application still remains highly competitive. It's become increasingly more technical and sophisticated. There's way more focus on maintaining compliance with the CDFI fund. So they're going to be looking back at previous rounds to make sure that you are saying what, you're doing what you said you were going to do, and you're following all the guidelines within the program. So now you can only lose maybe 3.5 points out of a total of 110 points in the application and still be considered for allocation. So we're going to dive into the 5 key sections of the application today. There are also 5 exhibits that accompany the narrative responses. We're not going to go into like super great detail about those, but those exhibits are going to correspond to your proposed pipeline of investments, your track record investments, your organization's experience in terms of staff, board members, and consultants. You'll discuss your asset management and operating budget for your CDE, and then lastly, your organization's investor strategy. So the application goes through a 2-phase review process. Parts 1 and 2 are scored by reviewers and then recommended to a panel for a phase 2 review as long as they meet a threshold scoring. And that panel is going to review the non-scored portions of your application to determine the organization's capacity for an allocation. So there are some responses within the application, however, that will end up in your allocation agreement. So for example, whatever your CDE is going to have a designated service area. You're going to commit to a designated service area within your application, and that is also going to end up in your allocation agreement if you are successful. So Lisa is going to dive into some more of those commitments later in the presentation, but essentially just know that if you are committing to an activity in your application, you can pretty much count on fulfilling that commitment once you're finally ready to deploy. And then lastly, the executive summary. It's not a scored component of the application. And so people maybe think that they don't, or they shouldn't spend a lot of time on it. But this is really an opportunity for you to set the stage for your CDFI fund reviewer and tell them who you are. This is your time to let your organization shine. So you get to talk about, what is your mission? Where is your passion? And what problems are you trying to address in your community? So part one is focused on your organization's business strategy. And here you're going to answer 3 overarching questions. Essentially, what have you done? What will you do? And how will you do it? So you'll start by selecting the types of key uses and activities. So you can choose from loans or investments to quality, so investing in projects, loans or investments to other CDEs, purchasing loans from other CDEs, or providing financial counseling. And then the ones you select here will end up in your allocation agreement if you receive an award. Next, you'll provide an overview of the financial products that you'll provide with that allocation, and also discuss the flexibility of that product. So you'll talk about all the rates and terms and features that are otherwise not available in the conventional financing market. And part one, you're also going to discuss your planned investments, or what's known as your representative pipeline. And that includes the business types, the amount of allocation that you would be putting towards that project. And it's important to note here that this is, like I said, this is just a representative pipeline. And so you are not held to investing in these specific projects, but they should be illustrative of the types of projects that your organization has historically invested in. And that, it's reasonable to assume that you have a pipeline that you can deploy into. In part one, you're also going to talk about how your CDE selects projects. So that's diving into your investment strategy. Maybe you're a CDE that focuses on third-party real estate deals, and that's all you do. Or you're an organization that, you are only going to invest in projects that create, quality and accessible jobs. Or perhaps your organization is focused on community health care facilities. And then you'll also describe the due diligence that you complete for those investments to ensure that the project is actually completed, that the project has sound financials and qualified management, and then also that there's evidence of market demand for that type of project in the community. And then part one also provides an opportunity for your CDE to commit to providing what is known as an innovative investment. This is not a scored response. However, if you meet that threshold scoring, if the panel recommends your CDE for an award, it could impact the size of your award. And Lisa's going to cover the different types of innovative investments that your CDE may choose a little bit later. And then you're going to follow up with a discussion of your closed investments from the last 5 years. And really what you're trying to prove here is that your pipeline is substantially similar to your closed investments. So you'll talk about the business types, the key uses, construction, rehab, acquisition, operating capital equipment. For both your new markets, and if you have non-new markets lending products, you would want to talk about those there as well. And then you would also talk about your track record of deploying capital to non-metro communities, as well as your strategy for if you have a non-metro deal in your representative pipeline, how will you actually deploy it in that community? So you are given an opportunity to commit to deploying a certain percentage of your allocation to non-metro communities. And if you do so, that will end up being memorialized in your allocation agreement. In part two, you're going to discuss all of the impacts that your CDE has facilitated in your service area through your closed projects, and then also project out your anticipated outcomes through your pipeline projects. So this section is going to focus on 3 key areas. How do you measure impact? How do your pipeline impacts compare with your track record? And how are you ultimately accountable to low-income people and communities? So you'll talk about your CDE's ability to target investments to areas of higher distress, and that includes, economic distress, and Lisa will go into more of those characteristics of distress a little bit later. Non-metro communities, medically underserved areas, perhaps your project is located in a distressed Appalachian or Delta Regional Authority location. So these are things that, as you're thinking about how to really expand the impact of your investments in the communities that need it most, how are you targeting those communities? And then you'll also quantify the outcomes that you anticipate will be generated by your pipeline, and then discuss the methods and metrics that you're using to measure that impact and track that impact. So there are several types of community impacts that you can select, but you should really ensure that you have the track record to actually support your planned investments for those impact types. So we see a lot of CDEs that are focused on the creation of quality and accessible jobs in low-income communities, or the provision of community goods and services, commercial goods and services. Some CDEs are focused on providing financing to Native American and minority-owned businesses or sponsored projects. Some CDEs like to participate in for-sale housing, and others, want to focus on environmentally sustainable outcomes. So it really, the impact should align with your mission and the impact that you are desiring to create in your service area. And then lastly, here, you're going to discuss your CDE's accountability to low-income people and communities. And that's really just ensuring that your project aligns with the community goals, that there's low-income community representation on your boards, that you are actively engaging with the community when you are trying to invest or fund a project. And essentially the CDFI fund just wants to make sure that your investments are actually addressing an identified need in that community, and that the project has local buy-in. Part 3 is all focused on the management capacity of your CDE. So you're going to dive into who does the work, how are they qualified, and what systems do you have in place to operate your new markets program. It's accompanied by Exhibit C, and that is a table that details all of the qualifications and experience of your key staff, your board members, and your consultants. So you're going to describe the roles and responsibilities of those who are responsible for identifying pipeline projects, for underwriting investments, for structuring transactions, raising capital, maintaining compliance, managing your assets. So a lot of everybody who's keeping your program up and running, essentially. And then similar to part 1, when we spoke about, the due diligence that your CDE undertakes when looking to invest in a future project, you'll talk about your track record of actually enacting that due diligence on your closed investments. And then lastly here, you're going to elaborate on the fee structure of your CDE, which corresponds to Exhibit D. So you'll discuss the fees that are received by your organization, the CDE, as well as the investor and other third parties, and then really quantify the overall financial benefit that is received by the Qualic B from your proposed pipeline. Part 4 is solely focused on how you're going to capitalize your deals. Who raises capital and how do you do it, essentially? So you're going to discuss your track record of raising capital, which includes grants and equity, both market rate and below market rate debt, which corresponds with Exhibit E. In Exhibit E, you're going to break down your 5-year track record of raising capital by type of capital. List the QEI investors from previous allocations, and if applicable to you, you would also list the QEI investors from whom you have secured commitments from your proposed pipeline of projects. So this section also provides an opportunity, again, to break down the financial benefits that are achieved by the CDE, the Qualic B, and the investor. And then if applicable to you in your pipeline, you'll discuss any planned multi-CDE investments that are in your proposed pipeline. Part 5 is going to be focused on your previous awards. And so a brief question about previous awards received by received from the CDFI fund. That could be the New Markets Program, that could be the Financial or Technical Assistance Program, Capital Magnet Fund. So just a quick check mark of yes, they've reflected all of my awards here. But really part 5 is a chance for you to talk about how great your projects are. So you'll talk about the largest investments from your 3 most recent allocations, and you're going to get a chance to dive deeper into a description of the project, the wonderful community impacts that were achieved from your investment, and then you'll break down the fees and expenses and sources of leverage for that deal. And then also provide a but-for statement. So in New Markets world, that's essentially saying that but for the New Markets tax credit subsidy, this project would not be able to blank, whether that's this project would not be able to move forward, period. This project would not be able to move forward at the size and scope that we want, or, perhaps we can't offer the below market rents that we would like for our nonprofit tenants because we don't have the New Market subsidy built in order to do so. And then you'll provide information about any multi-CDE investments and how those costs were distributed so that you're not going to unduly burden the project with all those fees. And then essentially, lastly, confirm that your investments were in alignment with the relevant application. And that would be in terms of geography or service area, the types of financial products that you were offering, and the types of businesses. And with all that complete, you'll submit your application and you'll wait a short 10, 11 months until awards are announced. So I hope you were paying attention. We have a poll question here for you. What is one part of the application that is included in your allocation agreement? So if you are successful and you receive allocation, what element of your application is going to end up in your agreement that you will have to fulfill? Specific pipeline projects, your geographic service area, a commitment to investing in metropolitan areas, or all of the above. We'll give you all just a couple more moments. So if you haven't put in your response yet, go ahead and do so. No one was paying attention. 62% of you were not paying attention. So let's break this down real quick. Remember that the pipeline you're proposing is just a representative pipeline. You are not held to committing to the specific pipeline projects that you put in your application. A lot can change from the time that you submit an application to getting an award to being able to deploy. So there's no expectation that you're going to invest in XYZ manufacturing plant, because who knows what's going to happen to that project over a year from now. Commitment to investing in metropolitan areas. It's actually a commitment to investing in non-metro areas. And so really the CDFI fund is wanting to see a targeted effort, if it's feasible for your organization and it makes sense for your organization, to invest in these non-metro, rural, underdeveloped communities. So the correct answer here is actually geographic service area. Your CDE, like I said earlier, is going to have a designated geographic service area, and that's something that you're going to commit to in your application and agreement as well. You have another opportunity with poll 3, so.
Okay, thank you, Lauren. So we're going to take you to the next step now. And Lauren has explained to you all the things that CDs need to think about in completing an application and applying for New Market Tax Credit allocation. And so now we're going to assume that your application was successful, and the CDFI fund notifies you and says that you have won. And now we're at the point of what do you do next? So the IRS rules for the New Market Tax Credit Program can be found in Code Section 45D. Without going into too much code talk, I'm going to give a basic overview of the main rules to be aware of when you're administering your new market tax credit allocation. The first overarching determination of whether a potential project qualifies to use new market tax credit financing is the location of the project. And this could be either the physical location of the project's property, the location where the services are being performed, or where revenue is being generated. The project must be located in a low-income census tract, and this is defined as a census tract with a poverty rate of 20% or greater, or with a median family income of 80% or less. So once you determine that your project is located in a low-income census tract, you'll need to verify that all of the other players in the transaction also qualify to participate per the IRS rules. New market tax credit allocations can only be awarded to CDEs, and only CDEs can provide new market tax credits to investors. To become a CDE, an organization must apply to the CDFI fund and must show that the primary mission of the organization is to serve low-income communities or low-income people. The CDE also has to show that it is accountable to the low-income communities it serves by having board members on either the governing board or the advisory board that represent the interest of the low-income community. Representation can be achieved by board member in several ways, including residing in a low-income community, owning a business located in a low-income community, serving on the board of a nonprofit or a charitable organization that has a mission of serving low-income communities, or you could be a religious leader whose congregation is located in a low-income community. It's important to choose your board members wisely because this is a determining factor for remaining compliant with the new market tax credit program rules. After the CDE has identified an eligible project, the next step is to find an investor for which to sell the tax credits. The sale of the tax credits to an investor is also called a QEI, a qualified equity investment. IRS rules require that the tax credits can only be sold for cash, and the investor makes an equity investment in the CDE in exchange for the tax credits. After the receipt of the QEI, the CDE must then invest at least 85% of the cash received into a QUILICI. We have lots of acronyms in this industry. Sometimes we feel like we're speaking our own language, but we'll go through and break down all of these acronyms so you'll be able to understand the language too. So the IRS defines a QUILICI as a qualified low-income community investment. Again, the CDE will use at least 85% of the QEI it received to invest in low-income community. And there are 4 different ways the CDE can do this. The most common way is by investing into a qualic B. And in a moment, we'll talk about what a qualic B is. This investment can be in the form of a loan or an equity investment. A CDE can also make a QUILICI by purchasing a QUILICI from another CDE, by investing in another CDE, or by offering financial counseling services to businesses located in low-income communities and residents of low-income communities. So as I mentioned, the most common way to make a QUILICI is to invest in a qualic B. So the IRS has determined what types of businesses can receive a QUILICI by the following requirements. So a business has to show that 50% of its gross income is derived within a low-income community. 40% of the business's tangible property is located within a low-income community. 40% of the services performed by the employees also must be within a low-income community. Also, in looking at the business's assets, less than 5% of the assets are allowed to be in collectibles, and no more than 5% of the business's total assets may be what is called non-qualified financial property. This includes things such as loans, stocks, partnership interest, and even cash in excess of reasonable working capital. So there's also a few restrictions on what types of businesses do not qualify. And these include residential rental property, farming businesses, and what the IRS refers to as sin businesses, which includes golf courses, country clubs, massage parlors, hot tubs or suntan facilities, racetracks or other gambling facilities, and stores that sell packaged alcohol. So when people ask what kind of projects can qualify for a new market tax credit investment, it's really about what kind of businesses can't. So there's this small list of things that do not qualify. And if you think about the list, it's mostly businesses that don't really produce worthwhile community benefits to the community. Okay. So those are the basic IRS rules that govern the New Markets program. The IRS has an all or nothing policy when handing out tax credits to investors. There's a 7-year compliance period beginning on the day the CDE receives a QA from the investor and ending 7 years later. The investors earn the tax credits each year over the 7-year period and can include on their tax return the credits earned each year. However, if any time during the 7-year period, the IRS could come in and recapture the credits or disallow the credits from the investor. This would require the investor to refile its previously filed tax returns and exclude any deduction for the tax credits previously claimed. So this is not something anyone wants to happen, and this is why the CDEs and the investors monitor transactions so closely throughout the 7 years. So while IRS recapture sounds really scary, there are actually only 3 events that can cause an IRS recapture. The first event is if the CDE ceases to be a CDE. Going back to our definition of what a CDE is, this will happen if the CDE starts engaging in other activities and no longer has a primary mission of serving low-income communities or low-income people, or if the CDE loses accountability to the low-income community through its board representation. The rule for compliance is that at least 20% of all board members need to be LIC representative, but you'll find in reality that most CDEs have a much higher requirement for their board members. The second recapture event happens if the QEI ceases to be substantially all invested in a QUILICI, in a Qualic B. When a CDE makes a QUILICI by issuing a loan, the principal of this loan must remain in the Qualic B during the 7-year compliance period. In other words, the Qualic B cannot repay this loan during the 7 years, which is why you will see almost all new market tax credit loans being made as interest-only loans with no principal payments. The third recapture event happens when the investor's QEI is redeemed by the CDE. Remember, the investor makes an equity investment in the CDE. So during the 7 years, the CDE cannot return any of the principal investment back to the investor. Looking at these 3 events, the IRS wants only good stewards for the new market tax credit program to administer the tax credits. And once the investment is made, the IRS wants the funds to stay invested in the low-income community for 7 years to give time and resources to accomplish the community benefits intended to be achieved by the program. So it seems like an appropriate time after talking about the IRS to ask you, what is your biggest worry? Is it not getting a new market tax credit allocation award? Is it causing an IRS recapture of the tax credits? Is it meeting the CDFI fund requirements, which we will talk about next? Or is it all of the above? So we'll give you a few minutes to think about those. And there's not one right answer. There could be other worries that you have, but hopefully not. Hopefully that's what we're here for, is to take away some of those worries, to give you a good understanding of what is expected and what you need to do to stay in compliance with the program. All right. Yeah, so it's pretty evenly split. People are scared of the IRS, worried about not getting an award, meeting the CDFI fund requirements, and generally just worried about all of it. So that's okay. So we're going to go through now some more details to take away some of those worries. All right. So if the IRS didn't give us enough rules to follow, the CDFI fund also imposes its own set of rules and restrictions regarding how you can deploy your allocation after you win an award. The IRS rules are law, and if they are not followed, could lead to big financial penalties and trouble with the IRS. However, if you don't exactly follow the CDFI fund rules, it most likely won't result in any penalties or fines or recapture, but it will most likely prevent you from ever being able to participate in the new market tax credit program again in the future. Like Lauren said, the new market tax credit industry is very competitive, and the more you can make the CDFI fund happy, the better chance you have of remaining an active participant. So after you write your winning application, the CDFI fund will contact you and congratulate you on winning. And the next step is to sign your allocation agreement with the CDFI fund. This becomes your roadmap to follow in deploying your allocation and investing in your new market tax credit projects. Some of the things you write about in your application will be your general investment strategy and community benefit goals, but some of the things you choose in your application will actually become contractual with the CDFI fund. So we'll go through these items from your application that will result in this contractual restriction on investing in your award. So the first thing that you will choose and become bound to through your allocation agreement is what kind of CWILICs you will make. And we've mentioned these before. There are 4 ways that you can invest. You can invest in QUILIC Bs, invest in other CDEs, purchase loans from other CDEs, or provide financial counseling. So whatever you chose in your application, that is how you'll have to invest your award. You'll also, in your application, choose your service area. This is where you say that you're going to make your investments. Your service area can be as small as 1 county, 1 state, several counties or several states, or even as large as the whole country. But if you choose in your application to make all investments in, let's say, 1 state, then after you receive your award, that is the only place you'll be able to invest your allocation. Another item from your application is whether you said you would invest in unrelated entities. When you describe your pipeline projects in your application, you have to disclose if any of the projects are related to your CDE or to the investor. If you said no, then you would not be allowed later to invest in a project that shares common ownership with the CDE or the investor. Most investors will require that a separate sub-CDE be formed to house each separate new market tax credit investment. If you're using a sub-CDE to receive the QAI and to make the CWILIC, the sub-CDE will need to be listed as a subsidiary allocatee in the allocation agreement. There's an application process to enjoin additional sub-CDEs after the agreement is final, but you cannot use a sub-CDE for a transaction if it has not been added to your allocation agreement. So Lauren described part of your application is talking about the types of products that you will use to deploy your allocation. Most of the time, these are going to be in the form of loans, and the CDFI wants to see loan products that have terms that are more favorable to the borrower than traditional market terms. So you can choose in your application to what extent your loan products will be more favorable than market rates. And this can range from 15 to 50% below market interest rates. And you can also choose between 2 or 5 of additional flexible terms. So however you describe your project in your application, that is what you're going to have to incorporate into your loan products when you actually deploy your allocation. As mentioned before, you can choose whether you want to invest in non-metropolitan census tracts or if you're going to invest in affordable housing. If you do have these types of projects in your pipeline in your application, you will be required in your allocation agreement to deploy whatever percentage you said that you would deploy in these areas. QEI usage is another application question that will become contractual. This refers to how much of the QEI you say you will invest in quickies. Remember, the IRS rule is that at least 85% of the QEI must be invested in quickies. However, if you say in your application that you will invest 90% or even 100% of the QEIs, then you will be contracted to do that when you actually deploy your allocation. So in your application, you'll also discuss what kinds of communities you will invest in. And these are the targeted distressed communities that Lauren mentioned. So the IRS requires that to qualify for a new market investment, the project only has to be located in a census tract that has at least 20% poverty or less than 80% median family income. However, the CDFI fund wants to see that the QEIs are being invested in targeted distressed communities with characteristics much more severe than the IRS requirement. If you say in your application that you will invest in these targeted distressed communities, then you will be required to do so. There's a list of 16 different characteristics that meet the definition of targeted distressed, but 5 of those are labeled as severely distressed. These severely distressed communities are characterized by poverty rates greater than 30%, median family income less than 60%, unemployment rate at least 1.5 times the national average, non-metropolitan census tracts, and targeted populations. So if your project is located in one of these severely distressed census tracts, then it meets your allocation agreement requirement. If not, there is a secondary list of characteristics for which you'll have to choose two to be compliant in investing in targeted distressed communities. So the list is on the screen. Some of these include brownfield sites, Indian reservations, medically underserved areas, opportunity zones, FEMA disaster areas, or food deserts. So in your application, again, if you choose to invest in these areas, you'll be required to do so after you receive your reward. Oops. So the CDFI fund has also defined certain types of investments as being innovative, which in practice, we know this just really means being really hard. Some think that this might influence the CDFI fund to award a CDE more allocation if they choose to make these kinds of investments. Whether true or not, if you say in your application you will make these investments, you'll be contracted to do so in your allocation agreement. So these types of investments includes investing in other unrelated CDEs, investing in states which historically have received less new market tax credit investment per capita than other states, making small dollar or short-term quickies, making investments in non-real estate projects, which means investing in business, providing financing for business for their inventory or equipment or working capital, something that's not related to constructing a building. Also, innovative investments include investing in federal Indian reservations, Hawaiian trust lands, and Alaska Native Village statistical areas. And then the last one is investing in minority-owned or Native American-owned CDEs. So these are some areas that CDFI fund has designated where they want to see more investment, but it's also the hardest types of investments to make. So given that the industry is so competitive, CDEs will try to write the most compelling applications and try to promise all of the most wonderful community benefit outcomes and have a pipeline of projects in the most distressed communities. And this is exactly what the CDFI wants, but just remember that whatever well-intended promises you make in your application, you could end up being contracted to do so, and this could restrict how and where you can make your actual investments after you receive your award. In order to ensure that CDEs are being good stewards of the new market tax credit allocation that they are awarded, the CDFI fund included a new requirement in the allocation agreement this past round. The application requires CDEs to discuss their processes and describe their procedures for how they identify projects, how they underwrite their projects, how they monitor the projects and the community benefit outcomes, how they manage their investments, among other things. This new requirement now makes a contractual obligation for CDEs to adopt and adhere to written policies and procedures, including investment committee policies, which are approved by the CDE's board of directors, setting forth how the CDE will use the proceeds of the QEI to make investments in accordance with the allocation agreement. So if your CDE doesn't already have policies and procedures in place, this will be something that will need to be developed really prior to writing your application, but most definitely before you start deploying an allocation award. The last thing I want to mention about compliance with the allocation agreement and the application is that the CDFI fund does track to see that CDEs are being consistent with what they say in their applications. The areas they look for consistency include the types of products you offer, your quality types, the amount of fees that you charge, and where you make your investments. So your next question is probably, how does a CDFI fund check to see that CDEs are in compliance with their allocation agreements and are being consistent with their applications? The answer is AMOS. So the CDEs will be required to make several reports to the CDFI fund during the term of their allocation agreement. So when a CDE first receives an allocation award, or I'm sorry, when a CDE first receives a QEI from an investor, they will be required to make an allocation and QEI tracking report. And this gives, this lets the CDFI fund know that the CDE has received a QEI, and it gives details about who the investors are. Each year, the CDE will also file an ILR, which is institution level report, which just gives general information about the operations of the CDE. It will also have to file a TLR, which is a transaction level report. And this TLR gives very detailed information about each project that the CDE invests in. There are two types of TLRs. There's a notes TLR and a projects TLR. The notes TLR will give specific information on the loans made by the CDE, include such data as the interest rate, origination fees, amortization type, interest only period, all of those flexible terms that you talked about in your application. The project TLR will ask detail on the project itself and on the community benefits outcomes of the project. And it will include such data as the total project cost and other sources of financing. What types of businesses is the qualic B? Is it industrial, housing, health, community? What community benefits were achieved, whether it was jobs created, square feet of manufacturing, or office or retail constructed, number of housing units, capacity of community facilities. The project's TLR will also ask for detail on fees that the CDE charged and to who, whether the investor, borrower, or other parties, will be paying these fees. And this is where the CDE will also report what targeted stress characteristics were applicable to each project that they invested in. There's a lot of information that goes into these reports, and they are designed to monitor the CDE's compliance with the allocation agreement and with the application. So in addition to the ILR and TLRs, the CDEs must also have an annual audit of their financial statements, and these must be submitted to the CDFI fund. And finally, after each project reaches the end of its compliance period, the CDE will submit a QEI closeout report and a sub-CDE dissolution report if applicable. So these reports tell the CDFI fund all of the good things the CDE is doing with their award. However, the CDFI fund also wants to know if any bad things have happened after receiving an award that may affect the CDE in any material way. These are things that you would normally consider to have a material effect on any business, including court proceedings against the CDE, occurrence of an IRS recapture event of default of an allocation agreement, an acquisition or merger of a CDE, or replacement of key management officials that were talked about in your application. However, there are other events that the CDFI fund has specifically mentioned should also be reported to the CDFI fund as a material event. And these would include a change in the strategic direction, mission, or business strategy that might have influenced the merits of awarding the application and results in the allocation use being generally inconsistent with the strategy set forth in the application. Also included in these material events are a change in the board of directors, which caused the LIC representation to fall below 20%, or an opinion other than an unqualified opinion on the CD's financial statements. Okay. So with all of the compliance and reporting that has to be done with these investments, it's good to have a good process of managing the investments throughout the compliance period. And this will include servicing the loans. The CD will be responsible for collecting the interest and CD fees, making distributions to the investors, monitoring the loans to make sure that the borrower is performing well financially so that it can continue to make interest payments on its loans, monitor the quality for compliance with the new market tax credit rules. And then the CDEs will also have to prepare accounting, audits, and tax returns for the CDE and for each sub-CDE that it uses. So the last thing I want to touch on, and which is really the actually the most important thing about the new market tax credit program, and the reason the program exists, is the community outcomes tracking. Community benefit outcomes are the heart of the new market tax credit program, and the reason CDEs choose their particular projects. In the application, the CDEs choose which of these benefits they're going to track based on their overall mission and the needs of their service area. CDEs certainly don't have to choose all of them, but should choose the ones that they feel that they will have the greatest impact with. Whatever community outcomes the CD chooses, it must be diligent in projects that can provide these outcomes, and also must be diligent in monitoring and reporting the outcomes during the compliance period. This will require continued communication between the CDE and the project throughout the compliance period. The results of prior investments will be disclosed in future applications, and the CDFI fund uses that track record and how well the CDE was able to create meaningful community outcomes to determine if the CDE will be given additional awards. The more you can talk about this, the more you can talk about the success of your projects, the better your story and your application will be. And so that brings us to our last polling question. So I feel like we've thrown a lot of rules and compliance talk at you, and we want you to know that we are here to help you. We offer services covering everything from strategic planning, if you're just getting into the industry, if you're already a CDE, we can help with writing or reviewing your next application. If you've already won an award and are just feeling a little bit overwhelmed, we can provide full compliance, asset management, and accounting services. And we also have a team of quality consultants who can help you get your project ready and marketable. And with that, if we have a couple minutes left, we can take any questions that you may have.
Great job, ladies. I've been looking at the questions that they've been coming and trying to answer some. We do not have slides that are available, but this presentation is recorded. So if you want to play it back and catch anything, you're welcome to. And then also, please reach out, as Lisa and Lauren have both mentioned. We're all part of a larger team that's happy to help if you guys have any follow-up questions. So Maddie, I don't think there was anything else in the Q&A we didn't cover, but wanted to just end with a note to everybody who's still with us. Thank you for joining us today. If you have questions, like I said, please follow up. And we have 2 more parts of this 4-part series. On June 21st, we'll have an hour-long presentation on financing capital projects with new markets. That's the project finance team. Thanks for all the love and the reactions for everybody. That session will be led by our project finance team, and they'll help you walk through how to make your project competitive and receive allocation. And on July 26th, there will be the 4th session, and that one is organizations and their next steps in the community development journey. And basically that one is if you're a part of the New Market Tax Credit Program and you really want to see something else or start a new program, offer a new product line, you're a CDE and you want to be a CDFI, you're a CDFI and you want to be a CDE, you want to get new markets and you haven't done that before, we have a service line that helps people think about their next steps, helps them fortify their plan, and then build that foundation strong so they can build that next layer of service. So that session will be July 26th. And with that, we are exactly at time. Thank you, everybody.